Hello, and welcome along to the Deep Dive. It's great to have you with us. Today, we're diving into something pretty significant. The Bank of England has just cut interest rates. It's a big shift, really, and we want to explore what it actually means for you, for the markets, and for the UK economy overall.
It really is a key moment. It signals a change, doesn't it?
Yeah.
After all that tightening we saw, understanding what's behind it is, well, it's crucial.
Absolutely. And to help us make sense of it all, we're joined by Dr. Matthew Graham. Dr. Graham is a leading expert on monetary policy, and he's actually advised the Bank of England previously, so he brings fantastic insight. Welcome.
Thanks. It's good to be here. And yes, thank you for watching Westferry Times.
Great. Let's jump right in. The big news, the rate cut. Could you just lay out the basics for us? What exactly did the bank announce?
Certainly. So the Bank of England reduced the base interest rate. It was 5.25%. Now it's down to 4.75%. That's a quarter-point drop. And importantly, it's the first time they've cut rates since they started hiking them back in late 2021.
A quarter point. Okay. And was it a unanimous decision?
No, actually. The Monetary Policy Committee, the MPC, they voted 6-3 in favor. So a clear majority, but, not everyone was on board.
Interesting. And what reasons did they give? Why now?
Well, they pointed to a few things. GDP growth has been weak, certainly. Consumer confidence has dipped too. And maybe most importantly, those inflationary pressures we've all been feeling, they seem to be softening. The bank feels they're getting a handle on it.
Right. So it's not just fiddling with numbers. This signals something deeper about how the bank sees the economy.
Exactly that. It suggests the bank thinks, okay, maybe inflation isn't the number one enemy right now. The bigger risk might actually be growth stalling out. So they're sort of pivoting, changing tack to try and support the economy a bit more.
Okay, let's step back for a second. What's the bigger picture here? What's the economic climate this decision fits into?
Well, the headline inflation rate, it's come down a lot. Remember, double digits. Now it's around 3.2%. Big improvement. But other signs aren't so rosy. Wage growth has slowed down. People aren't spending as much in the shops.
Right.
Businesses aren't investing much. It's all a bit flat.
So we're kind of hovering near stagnation, maybe even a mild recession?
That's the worry, yes.
Yeah.
The economy is definitely struggling for momentum. So this rate cut is really motivated by trying to prevent that slowdown from getting worse, shifting from purely fighting inflation towards, trying to boost demand a little.
Makes sense. Let's bring it down to the household level then. What does this actually mean for people listening, for you at home? How does it affect our wallets?
Okay, well, the most direct impact could be for mortgage holders. If you're on a variable rate, or maybe a tracker mortgage, you might see your monthly payments drop slightly.
Okay, some potential relief there. What about loans or credit cards?
Yeah, possibly some small decreases there too over time. Don't expect anything dramatic overnight, but the cost of borrowing might ease a little. But there's a flip side.
Ah, yes, savers.
Exactly. Savings rates, which have been reasonably attractive lately, well, they might start to edge down a bit now.
So a bit of a mixed bag for consumers then? A slight easing of the pressure maybe, but not a game changer.
I think cautious optimism is probably the right phrase. It helps a bit, loosens the squeeze slightly, but it won't magically fix everything straight away.
Okay. And shifting focus to businesses and the financial markets, how did they take the draft?
Well, the immediate reaction in the markets was the pound dipped a little. That's fairly standard when a central bank signals looser policy, makes the currency slightly less attractive to investors short term.
And businesses. Were they pleased?
Generally, yes.
Mm.
Especially sectors like retail and construction, which are quite sensitive to interest rates. They've welcomed the move. But what they're saying now is they need a bit more clarity. What happens next? Will there be more cuts? They want clearer signals.
Which leads to the obvious question, are more cuts likely? What are the odds?
It really hinges on the data we get over the next 2 months. If inflation keeps falling and growth stays weak, then yes, it's definitely possible. We could perhaps see maybe 1 or 2 more small cuts later this year, but it's very data dependent.
Let's talk strategy. The bank's main goal has always been that 2% inflation target. Has that changed at all?
No, fundamentally that 2% target is still the anchor. It hasn't changed. What has shifted is their assessment of the risks. Right now, they seem to see the downside risks to growth as the more pressing challenge compared to inflation maybe flaring up again.
So they're aiming for that soft landing we hear about, like the U.S. Federal Reserve.
Precisely. Trying to guide inflation back to target without crashing the economy and causing lots of job losses, it's a difficult balancing act.
And how's the bank's credibility holding up through all this? They've faced quite a bit of criticism over the past couple of years.
Well, central banks are always under scrutiny, especially when things are tough. But this cut wasn't a huge shock to the markets. It was somewhat expected. That suggests the bank is trying to be predictable, avoid jarring moves. While there's always debate, I think markets generally still trust their overall judgment and commitment to that inflation target.
It's useful to look internationally, too. Is the Bank of England moving in step with other major central banks, or are they out on their own here?
No, it's definitely part of a broader, albeit cautious, global pivot. You're seeing the European Central Bank hinting quite strongly at cuts soon. The U.S. Fed is kind of in a holding pattern for now, but they've stopped hiking rates aggressively.
So the global picture is cooling inflation and rising growth worries.
That's pretty much it, yes. Inflation came down faster than many expected globally, and now the focus is shifting towards, well, making sure economies keep taking over.
Yeah.
The Bowie's move fits within that wider pattern of recalibration.
Is this like a coordinated thing? Are they all talking to each other and deciding together?
Not quite like a formal meeting where they all agree, but central bankers watch each other very closely. They operate in the same global environment, face similar pressures. So while it's not formally coordinated, their policies often end up moving in similar directions because they're reacting to the same sort of global trends.
Of course, cutting rates isn't without risks. What could potentially go wrong here? What are the downsides?
Well, the big one is getting the inflation call wrong. What if inflation proves stickier than they think? Or what if there's another energy price shock due to geopolitics? If inflation bounces back up, they might be forced into an awkward U-turn, having to raise rates again. That would damage credibility.
Ouch. Any other major risks?
The other risk is that maybe this cut just isn't enough. If energy costs stay high, housing costs remain a burden, maybe a quarter-point cut doesn't really boost demand all that much. It might not be sufficient to really get things moving if those underlying pressures persist.
It really does sound like walking a tightrope.
It absolutely is. Balancing, supporting growth with keeping inflation under control. It's a very fine line right now.
Let's zoom in on the housing market for a moment. That's always sensitive to rates. What's the likely impact there?
We might see a modest pickup. Lower borrowing costs could encourage a bit more mortgage lending, maybe tempt a few more buyers into the market. First-time buyers, in particular, could find things slightly easier. But let's be realistic.
Meal.
Meaning affordability is still a massive issue. House prices are high relative to earnings. Lenders are also likely to remain pretty cautious. They won't suddenly open the floodgates.
So we're talking more stabilization, perhaps a slight lift, rather than igniting another housing boom.
Exactly. Stabilization is probably the key word. Don't expect prices to suddenly take off again because of this single cut.
Okay. Looking out over the rest of the year then, what's your best guess? Where are rates and the economy heading?
Crystal ball time. My central expectation would be, as I said, maybe one or perhaps two more small cuts this year. That could take the base rate down towards, say, 4.25%. Alongside that, I'd expect inflation to keep easing, maybe getting below 3%. And hopefully, fingers crossed, we see a modest return to positive economic growth in the second half of the year. Q3 or Q4, perhaps.
But lots of ifs and buts attached to that, I imagine.
Always. It depends heavily on what happens with wages, global energy prices, the usual suspects.
Are there any wild cards we should be watching out for, things that could throw that forecast off course?
Definitely. Things like how China's economy performs that has big global knock-on effects. Volatility in energy markets is always a risk. And, things like the U.S. election later this year could introduce uncertainty that impacts global markets and potentially the U.K. too.
This has been incredibly helpful in breaking it all down. Before we wrap up, what are the absolute key things you think our listeners should take away from this?
Okay, I'd say, first, monetary policy is shifting, but cautiously. Don't expect drastic changes overnight. Second, there's some potential relief coming, especially if you borrow money, but it's not guaranteed huge savings. Third, if you're a saver, maybe keep an eye on the rates you're getting. And finally, well, uncertainty is still the name of the game. The economic path isn't fully clear yet.
Fantastic summary. Thank you so much. This has been a really valuable discussion.
It was my pleasure.
And that does bring us to the end of this deep dive. A huge thank you again to Dr. Matthew Graham for sharing his expertise. We really hope you found this useful for understanding what the Bank of England's decision means.
Thank you.
Thank you for joining us here on Westferry Times. We really encourage you to stay informed about these economic shifts. Do join us next time when we'll be exploring another vital topic for Britain's future. And if you haven't yet, please do consider subscribing to the Westferry Times YouTube channel. It really helps us keep bringing you these deep dives.
Goodbye.
Goodbye for now.